VAT, that three-letter word. For many entrepreneurs, it sounds like the monster under the business bed, right? But why does VAT even exist? Think of it as a national membership fee. Governments worldwide, including here in South Africa, levy value-added tax to fund public services and infrastructure. It ensures everyone who uses goods and services contributes to the collective pot. It actually started in France in the 1950s, but now it's a cornerstone of tax systems globally. Today, we're not just going to define it. We're going to go through a journey with Lerato, a passionate entrepreneur with an online craft business. We will see VAT through her eyes, her wins, her worries, her aha moments. This is your journey to VAT confidence alongside Lerato. First up, what is this thing called VAT? Value-added tax, as stipulated in the VAT Act, is an indirect tax on the consumption of goods and services in the economy. It's levied at each stage of the supply chain where value is added, from production to the point of sale. Basically, it's the tax your business adds to its sales price if you're VAT registered. But here's the flip side. You also get to claim back the VAT that you pay on your legitimate expenses. Lerato, with her online craft business, lands her first big order to supply her recycled bags to a local boutique. The boutique owner asks, "Will you include VAT?" Lerato thinks, "Oh no, another tax?" But then it clicks. If I charge VAT on my bag sales, but I paid VAT on my new industrial sewing machine, I only send the difference to SARS. It's a flow, not a one-way street. Now, why bother with all of this? Where does the money go? VAT is a critical component of the National Revenue Fund. It's allocated through the national budget to fund government expenditure on public services, social grants, infrastructure development, and healthcare, as prioritized by fiscal policy. So the VAT that you collect and pay, it doesn't just disappear into a black hole. It's what pays for the tar on the roads you use to deliver your goods. It helps fund the schools our kids attend, the hospitals that care for our loved ones, and the salaries of public servants like nurses and teachers. When you think about that, VAT feels different. It's not just a tax. It's you contributing directly to your community, to your country. A sense of pride settles alongside that entrepreneurial hustle. This is the big one. When is VAT registration not a choice, but a must? The Value Added Tax Act, specifically Section 23, mandates that any person making taxable supplies becomes liable to register if the total value of those supplies exceeds 1 million rand in any consecutive 12-month period, or if there are contractual grounds guaranteeing income exceeding 1 million rand in the next 12 months. In plain language, if your business hits 1 million rand in any 12-month window or year-long window, you are required to register for VAT. It's not an option at this point. Going back to Lerato, her business has been booming. She's been tracking sales for the last 10 months and it hits her. She's just crossed 1 million rand. She remembers she has to register for VAT and she goes online looking for what to do and how to register. Luckily, she finds a free 1-hour VAT confidence consultation with Chikambula. She books this consultation, has a 1-hour conversation with no jargon, just friendly advice about her business and what she needs to do next. If you want to be like Lerato, you can find the consultation link in the description below. But what if you're not at 1 million rand yet? Can you opt in early? The VAT Act allows for voluntary registration, provided the person makes taxable supplies and meets certain lesser requirements, such as exceeding 50,000 rand in sales in a 12-month period, or if they are conducting a business activity that can reasonably be expected to result in taxable supplies exceeding 50,000 rand in the next 12 months. Yes, you can choose to register for VAT even if your business sales have not crossed the 1 million rand mark. as long as your business is making at least 50,000 Rand. Registering for VAT can be a strategic choice to make your business more legitimate and to suit your clients. Let's get these two terms crystal clear. They are at the heart of VAT. Output tax is the VAT charged and collected by a registered vendor on the supply of taxable goods or services. Input tax is the VAT paid by a vendor on goods or services acquired for the purposes of making taxable supplies in the course of their business. In simple terms, output VAT is the VAT that you add onto your sales when you invoice your clients. And input VAT is the VAT that you pay your suppliers when they invoice you. So when you submit your VAT return to SARS, you take your VAT output and you deduct your VAT input and you pay the balance to SARS. You take the VAT that you added to your sales, then you deduct that you paid on your costs and you pay the difference to SARS. Simple, easy math. So let's talk tax invoices. Vendors who make taxable supplies must issue tax invoices that clearly state the VAT amount or include a statement that the price includes VAT at the standard rate. Currently, it's 15% in South Africa for most goods and services. Prices displayed to consumers must generally be VAT inclusive. What this means for you and your business is that when you invoice your clients, you need to make sure that your invoices are valid tax invoices. They need to meet certain criteria. You need to have at least your name clearly displayed on the invoice. It needs to have the label that says invoice or tax invoice clearly. It can't be a draft invoice or a pro forma invoice or anything like that. It needs to clearly say invoice or tax invoice. It also needs to add the details of your client, like the address, the registration number, the VAT number for your client as well. Similarly, you need to make sure that the invoices you get from your suppliers meet these requirements. Those invoices need to have your information clearly displayed. They need to say tax invoice. They need to have your supplier's address, your address, and need to have the supplier's tax number as well as your tax number. More importantly, these invoices need to have the VAT percentage and the VAT amount that is actually charged on that invoice. Remember, you can only claim VAT on legitimate expenses. So even if you receive a valid tax invoice from your supplier, but that expense is not a legitimate expense, you will not be able to claim that. Expenses such as your personal expenses and certain entertainment expenses are a no-go. Registered vendors must submit VAT returns, typically the VAT 201 form in South Africa. And they must make payment of any net VAT due to SARS by the prescribed deadline for each tax period, usually by the 25th of the month or the last business day following the end of the tax period. Failure to comply results in penalties and interest. In simple terms, what this means is that you need to file your VAT returns every month or every 2 months in South Africa and either pay or claim a refund. The VAT returns need to be submitted by the 25th of the month or the last business day of the month. So if the 25th falls on a Saturday or Sunday, then the last business day will be the Friday preceding it. So let's talk about the common mistakes that entrepreneurs and business owners make when it comes to VAT. The first big one is late registration. Many entrepreneurs register way after they've crossed the 1 million rand mark. At that point, you may incur penalties and interest. The second mistake that entrepreneurs make is they don't calculate their output VAT and their input VAT correctly, and they don't submit the correct numbers. If they get an audit from SARS, it may also result in penalties and interest, or they're paying more VAT than they should because they're not deducting, therefore impacting their own cash flow. The third mistake business owners make is claiming VAT on illegitimate expenses. You need to make sure that you keep accurate records of what's personal expenditure and what's business expenditure to make sure that you claim that right VAT. The fourth mistake that entrepreneurs make is late submission of their VAT returns. You need to make sure that you meet the deadline and you pay before the deadline. Even if you submit your VAT in time, if the payment is late, you will incur penalties and interest. So how can you avoid this? The number one cornerstone for avoiding these mistakes is keeping track of your income and your expenses. Knowing that as soon as you hit 1 million Rand, you need to register for VAT in that month. Making sure that each month you're tracking your expenses and allocating them correctly. So when it comes to filing your VAT returns and calculating your output tax versus your input tax, you already have that information available. Secondly, never spend the VAT portion of the money you receive from your clients. Keep that money in a separate account, let it earn interest for you before you make payment when the time comes to make payment. Remember Lerato? She's now in her second year of business and she's implemented the accounting software to keep track of her income and her expenses. She has trained her team on how to invoice correctly and to add the VAT portion to the invoices. She's also trained them on how to submit expenses and include them into their bookkeeping. She has grown in her confidence because they've hit every deadline in submitting their VAT and paying their VAT on time. And she has a separate account where she keeps the VAT portion of the sales that she makes and the payments she received from her clients. VAT is no longer a monster for Lerato. It's now part of her business rhythm. And whenever she hits a snag, she knows who to call. If Lerato's story inspires some questions about your own business, remember, there's a free 1-hour VAT confidence consultation that you can access in the description below. If you enjoyed this video, please leave a like and a subscribe so entrepreneurs and business owners just like you can find this content. I'll see you guys on the next one.